The twin revolutions of our time, artificial intelligence and cryptocurrency, seem to exist in the ether as abstract concepts, lines of code, and digital assets, but they don't run on ideas, they don't run on hype, they run on something far more tangible, far more constrained, and far more critical to our future. They run on power, they run on physical infrastructure, and they run on massive amounts of capital. Right now, the entire world is chasing AI stocks, captivated by the promise of godlike intelligence and exponential productivity gains. At the same time, a parallel universe of investors and technologists are arguing about the future of crypto, debating price targets for Bitcoin, and the utility of decentralized networks. The headlines are dominated by software, by algorithms, and by digital tokens. But this relentless focus on the surface-level applications is causing almost everyone to miss the single, most important, unifying thread that connects both of these world-changing technologies. The one factor that will ultimately determine the winners and losers in this new era. That factor is energy. Raw, unrelenting electrical power. We are standing at the precipice of an unprecedented energy bottleneck. The demand for computation, driven by both AI model training and the security of blockchain networks, is exploding at a rate our aging power grids were never designed to handle. Consider this: global data center electricity consumption is projected to double by 2026. That's like adding the entire energy consumption of Japan to the grid in just a few short years. Getting new power generation online is a monumental task, with permitting for new transmission lines often taking a decade or more. This isn't a hypothetical future problem, it's a present-day crisis of supply and demand. The digital gold rush is on, but there simply aren't enough shovels, or in this case, megawatts, to go around. This scarcity creates an incredible opportunity for companies that are positioned not just to consume power, but to own, manage, and monetize it. The companies that understand that the real value isn't just in the algorithm, but in the infrastructure that powers it. Today, we're diving deep into this thesis by breaking down two public companies that are attacking this problem from completely different, yet complementary, angles. These are not the names you hear debated on cable news every day, but they may matter far more in the next cycle than most investors realize. We're talking about Galaxy Digital, ticker GLXY, and Cipher Mining, ticker CIFR. First, Galaxy Digital. Led by Wall Street veteran Mike Novogratz, Galaxy is a diversified financial services firm dedicated to the digital asset space. Think of it as the Goldman Sachs of crypto. They aren't just a simple exchange, they operate across multiple sophisticated business lines. They have a massive institutional trading desk providing liquidity, an asset management arm with billions in AUM, and an investment banking division that advises on mergers and finances new projects. Their crucial connection to our power thesis lies in their deep involvement in financing the very infrastructure that underpins the digital world, specifically Bitcoin mining data centers. They provide the capital, the financial structuring, and the hardware procurement services that allow miners to build and expand. Galaxy is a play on the capital and financial infrastructure layer of the power stack. They profit from the growth of the entire ecosystem, insulated from the operational risks of running a single mining site. Their success is tied to the velocity of capital flowing into the digital infrastructure build-out. On the other side of the spectrum, we have Cipher Mining. Cipher is a pure-play industrial-scale Bitcoin miner. They are the boots on the ground. They don't just finance the infrastructure, they build it, own it, and operate it. Their entire business model revolves around one core competency: converting low-cost power into digital assets with maximum efficiency. They build massive data centers, procure the most advanced mining rigs, and, most importantly, secure long-term fixed-price power contracts. This is their moat. While other miners are exposed to volatile energy markets, Cipher has locked in some of the lowest power costs in the industry. But their strategy is even more nuanced. They are becoming a critical partner to the power grid itself, participating in demand response programs, where they get paid to power down during peak demand, helping to stabilize the grid. Cipher is a direct play on the power and physical infrastructure layer. They are turning an energy liability into a strategic asset, monetizing not just computation, but also their unique relationship with the power grid. So, we have two distinct approaches. Galaxy Digital represents a capital-centric, diversified bet on the growth of the entire digital asset economy, with a key focus on financing the miners. Their performance is highly sensitive to crypto market sentiment and capital market conditions. A bull market means more deals, more trading, and higher asset values. A bear market can squeeze their business lines. Cipher Mining, in contrast, is an operations-centric, industrial bet on the value of low-cost power. Their success is less about the daily price of Bitcoin and more about their operational uptime, their fleet efficiency, and their margin, the spread between their cost of power and the value of the Bitcoin they produce. They are built to withstand volatility and can even profit from grid instability. One is a financial play, the other an industrial one. One thrives on market expansion, the other on operational excellence and energy arbitrage. Understanding the difference between these two models is fundamental to building a robust portfolio strategy for this emerging theme. They offer different risk profiles, different sensitivities to the market cycle, and different ways to gain exposure to the undeniable collision of energy, compute, and digital infrastructure. In the coming analysis, we will dissect each company's strengths, weaknesses, and the specific scenarios that could drive their value, giving you the framework to decide how, or if, these stocks fit into your own investment thesis. Here's the uncomfortable truth. AI doesn't scale without electricity. Crypto doesn't operate without electricity. Data centers don't exist without cheap, reliable power. The next decade won't be won by apps alone. It will be won by companies that control infrastructure, energy access, and capital allocation. That's why GLXY and CIFR are not just crypto stocks. They are power-adjacent infrastructure plays. Galaxy Digital is often misunderstood. Most people think it's just a crypto trading firm. But in reality, GLXY is a digital asset financial infrastructure company. Galaxy operates across digital asset trading, asset management, venture investing, data center and mining exposure, institutional crypto services. At its core, GLXY is about capital, liquidity, and infrastructure, not speculation. Here's the key insight most investors miss. Galaxy isn't betting on one token or trend. It's betting on the entire digital economy, which is powered by compute, energy, data centers, institutional capital flows. Galaxy has exposure to mining operations, infrastructure financing, and data center-grade assets, meaning it benefits when power-hungry digital systems expand. As AI and crypto converge, Galaxy acts like a financial backbone for that ecosystem. One of GLXY's biggest strengths is institutional positioning. While retail investors chase price action, Galaxy structures deals, provides liquidity, manages assets for institutions, invests early in infrastructure. In other words, Galaxy makes money, whether markets are euphoric or cautious, as long as digital infrastructure keeps expanding. This makes it less dependent on hype and more tied to long-term adoption. So, what is the core investment thesis for a company like Galaxy Digital? When you strip away the noise of daily price fluctuations, the bullish argument becomes remarkably clear and is built on three foundational pillars that are reshaping our digital and financial worlds. First, the institutionalization of digital assets is no longer a future prediction, it's a present-day reality. We're witnessing a seismic shift as the world's largest asset managers, banks, and corporations move from a position of skepticism to active participation. The launch of spot Bitcoin ETFs was not the finish line. It was the starting gun. These products have unlocked a torrent of capital from registered investment advisors, pension funds, and family offices that previously had no compliant way to gain exposure. But this is just the first wave. The next phase involves more sophisticated products, yield-bearing instruments, structured derivatives, and tokenized real-world assets. Institutions don't just want to buy Bitcoin, they need partners for trading, custody, asset management, and strategic advice. They need a regulated, full-service prime broker that speaks their language and can navigate the complexities of this new asset class. This is the gap Galaxy was built to fill. The second pillar is the insatiable and convergent demand for computational infrastructure. The twin revolutions of artificial intelligence and decentralized networks are both fundamentally bottlenecked by two things: processing power and electricity. AI models are growing exponentially in complexity, requiring vast data centers for training and inference. Simultaneously, securing decentralized networks like Bitcoin requires an enormous and constant energy input. These are not competing demands, they are compounding ones. The world needs more data centers, more efficient hardware, and critically, more power. capital will inevitably flow toward firms that can build, finance, and operate this essential infrastructure. This leads to the third pillar, the scarcity of hybrid expertise. In this new paradigm, it's not enough to be a technology expert, nor is it enough to be a finance expert. Value accrues to the rare entities that are fluent in both. You need to understand the intricacies of derivatives pricing, the nuances of Bitcoin mining pool dynamics. You need the credibility to advise a Fortune 500 board on their blockchain strategy, the technical skill to execute a multi-billion-dollar trade across fragmented liquidity pools. Galaxy Digital has strategically positioned itself at this critical intersection of money, power, and compute. It's a bridge between Wall Street and Silicon Valley, a translator between traditional finance and decentralized technology. This is why the core thesis is so powerful. Galaxy doesn't need retail mania to win. It needs infrastructure growth. Its success is not predicated on meme coin speculation, but on the steady, methodical build-out of the digital economy's plumbing. To understand the potential outcomes, let's consider three distinct scenarios: a base case, a bull case, and a bear case. In our base case, the digital asset market continues its current trajectory. We see steady, albeit volatile, institutional adoption. Bitcoin and other major assets appreciate in line with their historical four-year cycles, but without a 2021-style parabolic blow-off top. In this world, Galaxy's trading desks generate consistent positive P&L from market making and derivatives flow. Its asset management arm sees steady inflows into its ETF and fund products, growing AUM and management fees. The mining business operates profitably, benefiting from its efficient fleet and strategic power contracts. Revenue grows, but remains tied to the market's cyclical nature. The stock price likely grinds higher, reflecting its status as a solid blue-chip proxy for the digital asset space. Now let's look at the bull case. This scenario is driven by an acceleration of the key trends. Here, the institutional floodgates open wider and faster than expected. Major sovereign wealth funds begin allocating a small percentage of their portfolios to digital assets, creating a massive sustained bid. Beyond Bitcoin, the tokenization of real-world assets, like real estate, bonds, and private equity, takes off, with Galaxy's investment banking division leading landmark deals. Crucially, the convergence of AI and crypto becomes the dominant narrative. Galaxy leverages its mining infrastructure and energy expertise to co-locate AI data centers, capturing value from both ecosystems. In this scenario, Galaxy's revenue streams decouple from simple crypto price beta. The company is re-rated by the market not just as a crypto bank, but as a premier digital infrastructure and technology firm. The value of its venture portfolio explodes as its seed-stage bets mature into category-defining companies. This is the world where Galaxy solidifies its position as the Goldman Sachs of the digital age. However, this is not risk-free. We must be clear-eyed about the potential headwinds, which brings us to the bear case. The primary risk remains the brutal cyclicality of the crypto markets. A prolonged crypto winter, far deeper and longer than previous cycles, would severely impact all of Galaxy's business lines. Trading volumes would dry up, asset management would face outflows, and mining economics could turn negative for extended periods. The second major risk is regulatory uncertainty. A hostile and uncoordinated regulatory crackdown in the United States or other key jurisdictions could stifle innovation and shut up profitable business activities. While Galaxy has prioritized a regulation-first approach, a seismic shift in policy, such as classifying major digital assets as securities without a clear path to registration, would create significant operational and legal challenges. Third, revenue volatility is an inherent feature of this business. Unlike a SaaS company with predictable recurring revenue, Galaxy's earnings are directly tied to market conditions, trading gains, and performance fees. This can lead to lumpy, unpredictable quarters, which public market investors often penalize with a lower valuation multiple. Finally, there's the exposure to early-stage ventures. While the venture portfolio holds immense upside potential, it is also illiquid and high risk. In a market downturn, these private company valuations can be written down significantly, and many of the portfolio companies could fail entirely, leading to realized losses. In the bear case, a combination of a brutal market, harsh regulation, and venture portfolio losses could put significant pressure on the company's balance sheet and stock price. Understanding these scenarios is key. The risks are real and substantial. However, they are also well understood. When you weigh the potential outcomes, it becomes clear that GLXY is best viewed not as a short-term trade on the price of Bitcoin, but as a long-term equity investment in the foundational infrastructure of the entire digital economy. It's a call option on the continued convergence of finance, technology, and energy, managed by one of the few teams with the experience to navigate it. Cipher mining is much more straightforward, but extremely powerful in concept. CIFR focuses on large-scale Bitcoin mining operations with one critical advantage: access to low-cost power. In mining, electricity cost is everything. The cheapest power wins. Cipher isn't just a crypto company, it's a power arbitrage company. CIFR secures long-term energy contracts, builds efficient data centers, optimizes mining operations around energy pricing. That means Cipher benefits when power is cheap, infrastructure is optimized, compute demand increases. This same infrastructure can later support AI or high-performance computing. What many investors don't realize, what gets lost in the noise of price charts and market sentiment, is a fundamental truth about the digital age. Bitcoin mining infrastructure is AI adjacent. In fact, it's more than adjacent. It's a direct parallel, built on the exact same foundational pillars. The digital gold rush and the artificial intelligence revolution are both at their core a race for one thing: power. The same critical factors that determine the success or failure of a multi-billion-dollar AI data center are the very same ones that define a world-class Bitcoin mining operation. First, and most importantly, is power availability. We're not talking about just plugging into the wall. We're talking about securing multi-megawatt power purchase agreements, often for years or even decades. This means having direct, reliable, and massive-scale access to the grid, something that is becoming the single greatest bottleneck for hyperscale AI development. Second, cooling. Every watt of electricity that goes into a server, whether it's running an AI model or a hashing algorithm, comes out as heat. Managing this thermal load efficiently is a complex engineering challenge. Inefficient cooling can dramatically increase operational costs and reduce the lifespan of expensive hardware. This is where industrial-scale solutions, from advanced air cooling to liquid immersion, become a competitive moat. Third, location. This isn't just about real estate, it's a strategic calculation involving proximity to low-cost power sources, favorable climate conditions to aid in cooling, and a stable regulatory environment that welcomes large-scale energy consumption. And finally, grid integration. This is the master-level play. It's not just about being a passive consumer of electricity, it's about becoming an active, symbiotic partner with the power grid itself. This is where the most sophisticated operators are creating immense value, and it's where a company like Cipher Mining, or CIFR, truly begins to differentiate itself. Companies like CIFR are quietly building what they call energy-first compute platforms. This isn't just a marketing term, it's a fundamental business philosophy. Instead of simply finding a place to plug in miners, they start with the energy source and build the entire operation around it. They secure long-term, low-cost power contracts, often directly with power generators. This strategy allows them to build a business that can be profitable even in the most challenging market conditions and, crucially, can adapt as the demand for high-density compute shifts and evolves. They are, in essence, arbitraging the cost of power, converting cheap electrons into valuable digital assets or, potentially in the future, into AI-driven computational results. So, what is the bull case for Cipher Mining? It's a multi-layered argument that extends far beyond the daily price of Bitcoin. First, the foundational premise. Bitcoin and its network remain relevant and valuable long-term. As a decentralized, secure store of value, its importance could grow in an uncertain macroeconomic environment. Second, the industry continues to consolidate. The days of mining in your garage are long gone. The halving events systematically increase the difficulty, squeezing out inefficient operators. This forces a flight to quality where only the most operationally excellent and financially disciplined companies survive. This consolidation naturally benefits the leaders, like CIFR. Third, and this is the crux of CIFR's strategy, power costs are the ultimate determinant of winners and losers. In a commodity production business, and at its core, that's what Bitcoin mining is, the lowest cost producer wins. When your primary input cost is locked in at a low rate, you can withstand price volatility that would bankrupt your competitors. This leads to the fourth point. CIFR has deliberately positioned itself as one of the lowest cost, most scalable power users in the entire sector. Their focus on securing long-term, fixed-price power contracts is their primary competitive advantage. This isn't just about getting a good deal, it's about creating predictability in a fundamentally unpredictable market. While other miners are exposed to the volatile spot market for energy, CIFR has a stable cost base, allowing for better long-term planning and financial resilience. If the broader thesis holds true, that the global demand for digital compute for both crypto and AI continues its exponential growth, then the operators who have mastered the art of acquiring and deploying power efficiently are the ones who will not only survive, but thrive. But let's be clear about the risks, because in a sector like this, they are significant. This is not a stock for the faint of heart. First, this is a highly cyclical business. The company's fortunes are, for now, inextricably linked to the boom and bust cycles of the cryptocurrency markets. Second, and directly related, revenue is almost entirely tied to the price of Bitcoin. A prolonged bear market in Bitcoin will directly and severely impact CIFR's revenue and profitability, regardless of how low their power costs are. While they can survive longer than most, survival doesn't always mean thriving. Third, this is an incredibly capital-intensive industry. Building data centers, procuring transformers, and constantly upgrading a fleet of tens of thousands of mining rigs requires hundreds of millions of dollars. This creates dilution risk for shareholders, as companies often need to raise capital by issuing new stock. Finally, there is significant regulatory and energy policy risk. Governments and grid operators can change the rules of the game overnight. New taxes, environmental regulations, or changes in how large power consumers are treated can fundamentally alter the economics of the business. This is a constant, lurking threat that requires careful monitoring. However, the most sophisticated investors are looking at how CIFR mitigates these risks, turning potential liabilities into strengths. This is the infrastructure angle in action. Take their relationship with the grid. CIFR participates in what are known as demand response programs. During periods of extreme grid stress, like a summer heat wave when everyone is running their air conditioning, the grid operator can pay large consumers like CIFR to power down their operations. This is a win-win. The grid avoids a catastrophic blackout, and CIFR gets paid for mining. This curtailment revenue is a non-correlated stable income stream that offsets their reliance on Bitcoin's price. They are effectively selling grid stability as a service. Furthermore, this capability makes them a perfect partner for renewable energy. When the wind is blowing or the sun is shining, producing an excess of power, CIFR can absorb that cheap, clean energy. When renewables are offline, CIFR can power down to conserve energy for residential and critical commercial use. They act as a giant, flexible load, a shock absorber for the grid, which is a service of increasing value as grids become more reliant on intermittent renewables. To manage the Bitcoin price risk, CIFR employs hedging strategies. While they hold a significant portion of the Bitcoin they mine on their balance sheet, they can also use financial instruments to lock in prices for future production. This might involve selling Bitcoin forward or using options contracts to create a price floor. This provides a degree of revenue certainty, allowing them to cover operational expenses and capital expenditures without being forced to sell their Bitcoin holdings at unfavorable prices. It's a layer of financial sophistication that many smaller operators lack. This combination of operational excellence, strategic grid partnership, and financial hedging creates a much more robust and defensible business model than a simple plug-in-and-pray mining operation. It's a model built for volatility. This is higher risk, higher reward, not a defensive stock, but for those who understand the intricate dance between energy, infrastructure, and digital value, it represents a compelling, albeit speculative way to invest in the very foundation of the digital future. Think of it this way: GLXY, Shaka Capital plus Finance, plus digital infrastructure exposure; CIFR, Shaka Power, plus energy efficiency, plus compute operations. One controls money and access, the other controls energy and execution. They're different plays on the same megatrend, powering the digital economy. If someone wanted exposure to this space, GLXY, diversified infrastructure and finance angle, CIFR, focused power and mining angle, position sizing matters, volatility is real, this is about long-term infrastructure, not short-term hype. AI, crypto and digital assets don't run on dreams, they run on power, capital and infrastructure. GLXY and CIFR sit in places most investors don't look, but those places often matter most in the long run. If you want a follow-up comparing APLD, IREN, CIFR and GLXY as a full power infrastructure basket, comment, Power Stack. This video is for educational and entertainment purposes only and is not financial advice. I am not a financial advisor. Investing involves risk, including the loss of principal. Always do your own research and consult a qualified professional before making investment decisions.